So, welcome to all of you from wherever you're joining us from. My name is Brian here. I'm the host of this program. So, this webinar today is part of an ongoing series by the LSE Hayek program, hosted by the Research Institute Stickett at the London School of Economics. So, the aim of this online series is to explore a range of different topics that are related in some way to the intellectual contributions of economist F.A. Hayek. These include, but are not exclusive to, individualism and economic freedom, the future of liberal democracy, social justice and welfare, decision making under uncertainty, macroeconomic management, and the importance of the rule of law. I encourage everyone to check out our future events on Eventbrite, which I will link below, and also our past recordings of similar webinars on this series on YouTube, which I'll also link later when the guest is speaking. So we're very pleased to have with us today Dr. Phil Magness, who'll be speaking on the topic of evaluating contemporary inequality statistics and trends. So this is a very timely topic given the discourse that we hear about inequality today, much of which is driven by data from some prominent economists who have published statistics on inequality, which our guest speaker is going to be critically evaluating today. So our speaker, Dr. Magness, he is a senior fellow at the Independent Institute and a David Theroux Chair in Political Economy. He has served as Senior Research Fellow at the American Institute for Economic Research and as Academic Program Director at the Institute for Humane Studies and Adjunct Professor of Public Policy at George Mason University. He has received his PhD from George Mason University School of Public Policy. His books include the 1619 Project, a critique colonization after emancipation, Lincoln and the movement for black resettlement, and The Rules of the Game, how government works and why it sometimes doesn't, and also Cracks in the Ivory Tower, the moral mess of higher education. His talk today is based actually on a book chapter titled The Economic History of Taxation and Inequality in the United States, published in 2020, which is a book chapter which I will drop later in the chat and also in the YouTube description. Please note that this webinar today is recorded and will be uploaded on YouTube over the next 1 week. So our speaker will be, presenting for approximately 40 minutes, followed by question and answer session, which I will moderate, lasting anywhere between 15 to 30 minutes, depending on the questions. So feel free to drop your questions over the course of the presentation, even before the Q&A begins, and use the Q&A function at the bottom. I will hold on to these questions and begin posing them to our speaker at the very end. So without further ado, I'll now hand the time over to Dr. Phil Magness for his presentation.
Thank you, everyone, for joining this evening. I'm going to share a slideshow here because this is going to be a very data-intensive presentation. And some of the data in there is actually brand new, stuff that I've generated and worked on in the last year or so. So it pertains to ongoing projects as well as things that are already in publication. But let me go ahead and get that pulled up, and we will get underway. So start the slideshow from the beginning. So the theme of my talk today really focuses on a body of economic research and literature associated with the economist Thomas Piketty, who has become synonymous with inequality research, not only in the United States but internationally. He has a major research center at the Paris School of Economics, and then several of his co-authors are affiliated with the World Inequality Database at UC Berkeley. And they've been making some very interesting claims over the past couple of decades that assert that inequality has reached a world rebound crisis position. And I want to dig into some of that data. Now, my analysis is going to focus on the United States first and foremost for a very specific reason. That is, Piketty and his co-authors developed their research approach using U.S. data, but it also has some implications for other countries. And at the end of the presentation, I'll show you some of the statistics there as well. But I want to start by talking about how this has spilled over into the mainstream news coverage, into the press. And here are just a sample of some recent articles in the past few years in the New York Times, where they make all these claims. This first one is 2019. the rich really do pay lower taxes than you. And this was based on research from Piketty and his co-authors, Emmanuel Saez and Gabriel Zucman. And it became something of a campaign slogan for the next several years, including being highlighted in President Joe Biden's State of the Union address last year. He basically asserted that the wealthiest taxpayers pay a lower tax rate than everybody else. There's also have been campaigns to impose new forms of taxation in the United States and in other countries. Some European countries have actually experimented with this, something we refer to as wealth taxation. Well, what is a wealth tax? Is distinct from an income tax because income is your annual earnings every year, and it's often assessed at a percentage based on that retained earnings that come home. A wealth tax is a tax on your net worth and the change in value in the net worth, provided it goes in one direction. Sometimes it's been referred to as a tax on unrealized capital gains. And the mechanism behind it isn't just revenue collection. The mechanism behind it is inequality. It's perceived to be causally tied to eliminating inequality. And overlaid with this, you also have a lot of anecdotal data. There's a YouTube video with Warren Buffett and Bill Gates where they were saying that they were asserting that they're undertaxed, that their rates are lower than Warren Buffett's secretary was the famous claim. Of course, my answer to that would be, well, why isn't Mr. Buffett writing a larger check to the U.S. government every year? Because he's perfectly free to do that if he thinks he's undertaxed. But the academic basis of this comes from basically these three economists. Thomas Piketty, who's very famous for writing a book called Capital in the 21st Century that appeared in 2014. It was based on empirical work with these two other fellows here. That's Emmanuel Saez, and then Gabriel Zucman is the junior figure in this triumvirate of inequality researchers. And one of the arguments I want to make is even though they have revived an interesting line of analysis on a subject that dates back, centuries in discussion, but they've tried to put it on an empirical basis. Most of their stats tend to place the thumb on the scale in a direction that asserts a very specific political narrative. They have claimed that inequality is rising and skyrocketing in most modern developed economies, and they claim that this is inversely related to the tax system. And therefore, there's a prescriptive result that comes of it, and that's in the form of new taxes. Basic economic dimension of this is that Piketty, Saez, and Zuckman have repurposed tax policy away from strictly raising revenue, although they're not opposed to that, but revenue to fund the government, and converted it over into a mechanism of setting a desired level of economic distribution. Their argument is that economic inequality is bad. It causes social tensions, other unrest, other problems associated with it. Therefore, it's in the interest of the government, in addition to raising revenue, to keep the distribution more equal, to take proactive steps to make the distribution more equal. And note that that is based on a claimed causal link between taxes and inequality. And I'll show you some of the data that they use to make this claim. And they want extreme progressive taxation to be implemented to fix this alleged skyrocketing problem of inequality, including to the point where they think that taxation is a mechanism to hold the private capital stock in check, prevent it from reconstituting and growing into what Piketty calls a rentier society, where the owners of capital are concentrated at the top and continue to feed themselves in ways that outpace income earnings for the rest. That's the basis of his underlying theory. Now, I have questions about that theory, and we can get into some of the data, but I want to fairly represent it to you, what he's asserting. And he also has a historical narrative here, and we'll go into that in just a moment. But why is this important? Well, it's been picked up by what Friedrich Hayek would refer to as the second-hand dealers in ideas, the intellectuals. And this is just a brief survey that I used for one example of this. It comes out of the law and political economy literature, which is a big institution founded at Yale University in the United States, that basically seeks to reorient legal analysis and legal scholarship to address the problem of rising inequality. And I point to this as an example because if you look at the law and political economy in the literature, the key paper of it's written by Jedediah Britton Purdy and a couple of co-authors, came out a few years ago. What they do is they all take Piketty's claim of rising inequality at face value as a given. Capital in the 21st century is essentially like a biblical text in this literature, and it's never really scrutinized. The claim of skyrocketing inequality is a stylized fact in other areas of academia. So this is an example from law. You could go into the humanities, you could go into historical analysis. They basically take Piketty et al. As a gospel truth without ever scrutinizing the sources of the data, and the understanding to see if his arguments actually are as robust as they take them as a given to do. And they all lead to the same endorsement of prescriptive policies such as wealth taxation. So what is Piketty and Saez all about? Well, it comes from a famous paper that was in Quarterly Journal of Economics, published in 2003, and this is the main takeaway graph of it. This is the U curve of inequality for the 20th and now into the 21st century. So 2003 paper, they've updated the data ever since then. So you see the claimed income share of the top 1% of earners from the beginning of the 20th century. And it follows this pattern of rising inequality. They attribute this to the late Gilded Age. But then certain events start to happen in the course of the 1920s, 1930s, 1940s related to the Great Depression and World War II that cause a disbursement of the capital stock in their narrative. They claim this is very closely tied to the imposition of high progressive federal income taxes in the 1930s and 40s. And as a result, the income share taken home by the top 1% begins to decline to this level period of roughly about 1945 to 1980 or so, which is kind of the middle part of the graph. This is the trough of the U curve. And Piketty refers to this as basically the golden age of equality in the United States. We'll see in a little bit that they also claim the same pattern plays out in most Western democracies. But then something goes awry in their story. From about 1980 to the present, they claim inequality is rebounding, and they have a very specific claim of why this rebound occurs. In the United States, it is Ronald Reagan cuts taxes. In Britain, it is Margaret Thatcher does the same thing. This is the alleged age of neoliberalism. Tax reform occurs, and in so doing, it supposedly unleashes capital accumulation at the top that starts to manifest in concentrations of high income individuals, the top 1%. These are the multimillionaire classes that they're referring to here. And supposedly that's remained unchecked until the present day. And you see their most recent years, so go back to 2021 here, they are claiming that 2021 we've hit levels of inequality that were last seen in the 1920s. And they'll publicly interpret it that way. I am saying, wait a minute, let's actually dig into this and see if the mechanisms are what they say they are. Now, overlaid with this is their assertion of causality. Just remember, you see that last chart? It's a U shape. Look at the dates there. And if I were to overlay the two of these charts together, these are the top federal marginal income tax rates in the United States. And they have similar graphs again for other countries. And what do you see? An almost inverse pattern that seems to correspond to that U curve. Taxes go up in the 1930s and 40s at the same time that inequality is dropping. Then you have this level period of high taxation at the mid-century. Then again, what do you have? 1980s tax rates go down, and that is the same period that inequality is supposedly rising and eventually skyrocketing. So they assert these two things are causally linked together. I think there are reasons to doubt this, and we'll get into a couple of those. First one is that the statutory tax rate is not the same thing as what people actually pay. So the rate on the tax books is different from what economists use as a term. It's called effective taxation. That's the actual payment itself. And effective taxation encompasses everything like deductions, loopholes, carve outs, as well as just standard features of the tax code that are designed to incentivize certain behavior with lower tax benefits. So, like charitable donations. And if you actually do an adjustment for the effective tax rate on $1 million plus incomes in the United States over the same period, instead of the blue line, you see that they're actually paying this orange line. And it's interesting because in the two tails of the U curve, 1920s and then 1980s to the present, the orange and blue lines converge, but at that mid-century mark, a big gap appears between the two. The statutory tax rates and the rates people are actually paying, their effective tax rates, often have, a good 20, 30, 40 percentage point gap in between them in that period. And it turns out there's a reason for this. So if you're trying to make a causal claim based on this data, you're actually making an error here because the causal mechanism is represented in the orange line, not the blue line. But I want to take a step back. How do we measure inequality? There's the Piketty-Saez distribution. Remember again that famous chart? And I want to call attention to 2 points on that famous chart. One is the drop, and the other is the rebound. Note the biggest drop occurs between 1940 and 1945. And the biggest rebound actually occurs over a course of about 2 years between 1986 and 1988. And they're very sharp turns, they're inflection points in the curve. And what I want to call your attention to is that these inflection points occurred at basically the exact same moment as major overhauls in the US federal tax code. And those overhauls affected the way that taxes were counted, collected, tabulated, recorded, in addition to changing the rates. So I'd ask the question here, is it really the rates that are determining the drops and rises in inequality, or is it actually some administrative effect of the tax code? Two, I'll call your attention to. In 1943, the tax reform overhauls initiate something that we refer to as automatic payroll withholding. So instead of writing a check based on your own accounting at the end of the year for your income, it comes out of your monthly paycheck as an automatic deduction. The reason being that this reduced tax evasion and tax avoidance. It also made the system much more easy to administer, but it certainly increased tax compliance. And they also do this at the exact same time. They changed the accounting formula used by the federal government from net income to what we now refer to as a universal standard. Internationally, it's adjusted gross income. So the exact year that these major events are taking place also registers as a drop in inequality. Then we fast forward to 1986, and you have almost the same thing happening in the other direction. Well, there's an overhaul of the federal tax code that changed the relative level of the U.S. corporate tax and the U.S. personal income tax. And there's an argument here that actually goes way back in the economic literature to 1986 itself that, if you alter two comparative tax rates, what do people do? They try to shelter their income streams under the more favorable rate. And what happened as a result of the 1986 reform is you had a shifting of income from one category to the other. Previously, if the corporate rates are relatively lower than the individual rates, what was previously registered as corporate income on the personal side is reclassified by accountants as personal income to take advantage of the more favorable rate, and vice versa if it went in the other direction. And there's quite a bit of evidence that this exact phenomenon played out as a result of the tax code changes in 1986. So already on the U curve, the two major turns in it just happen to align almost exactly with administrative overhauls in the tax code, not so much rate changes. That piques my interest because that tells me maybe there's a different causality here, and maybe even some of their statistics are the relics of administrative definitions rather than actual changes in income levels. But again, we see the stable period at the mid-century, and we're really going to pay attention to that. So how do you measure income? And how do you also measure wealth distributions? It's actually a very simple formula. You learned it in grade school mathematics. It's basic fraction. You have a numerator and a denominator. Well, what's the numerator? The numerator is a representation of personal income or wealth of, let's say, the top 1%. And all you basically have to do is calculate where that cutoff is, where that threshold is. And you can do this for the top 5%, top 10%, top 0.1%, some of the representations, if you only want to look at the ultra rich. But figuring out where that threshold is in a given year, and then you measure all income or all wealth above that top 1% threshold. And then you divide it into total income earnings or total wealth holdings of the entire US economy in the same year. Well, where do you get that? We go to national accounts, usually on the income side. Remember your national accounts formula? C plus I plus G plus your trade term equals output or GDP. Output also equals income. Income has a subset of it called the personal income subset. So out of GDP numbers, we can extract total personal income earnings in a given year for most major developed economies. And that becomes your denominator. But you'll notice here that it now matters quite a bit if you are accurately measuring the numerator and the denominator. Because if you have a denominator, for example, that's too small, it may actually look like income concentration is rising, or if it's too big, it may look like it's falling. So precision here matters quite a bit. And I've done a lot of digging into the Piketty-Saez Zucman numbers, and it turns out they're not all that attentive to precision. And in fact, they have a major problem with their denominator across the entire series. This is a representation that I did for a current paper that I have under preparation, although the first half of this was published about 2 years ago in the Economic Journal as a revision to the Piketty-Saez statistics. But what this shows is the Piketty-Saez total income denominator for the United States, what they use to perform that calculation, as a percentage of tax adjusted AGI as calculated from the Bureau of Economic Analysis, U.S. national accounts, basically, their representation of the same figure. And if this graph were working correctly, if Piketty and Saez had done their calculations correctly, they should be at nearly 100% in every single year. It should be a 1-to-1 ratio. The BEA numbers should match the Piketty-Saez denominator. What do you see instead? Their best years, they're hitting about 95% of national accounts income in their best years. In most years, it's actually drops down to about 90% of national accounts income, but it also fluctuates quite a bit. And in that fluctuation, you see two key points. First one is there's a really sharp drop where they go from about 95% of U.S. national accounts personal income to 85% in the course of just a couple of years. When does that coincide? Again, that World War II period of 1941 through 45. That's where the big initial drop is. And think about how this affects the calculation. If your denominator contracts, it looks like inequality would change here. If your denominator contracts at a bigger pace than what is actually on the books, it's also going to manifest itself in a changing pattern of income concentration at the top because you're dividing your numerator by this number. Now, if it's stable, on the other hand, even if it's off by a level, off by about 10 percentage points, you aren't going to see changes represented in the total income distribution. You'll only see changes represented in a flat level here. But then again, we see something else starting to emerge. They remain flat at 90% of national accounts personal income until about 1986. And then suddenly their denominator starts shrinking. And what do we know about a shrunken denominator? That manifests as rising inequality. So, in fact, we can explain some of the patterns and trends that we see based on errors in their denominator. This is a representation that I did that has corrections to the Piketty-Saez series. The first half of it, again, was published in the Economic Journal a couple of years ago. And the second half of it is updated in this working paper that Vince Geloso and I have. And what you see is the Piketty-Saez numbers. Those are represented in green and red. That's the original series from 2020, 2003, updated to the present. And then our corrections are all in the blue lines. And what you notice is for every segment that we analyze, there's actually a convergence in our numbers at that mid-century period. They're only off by a little bit. Piketty says exaggerate inequality by a little bit. But on the two tails of the U curve, the division widens. On the pre-1930s period, we actually have much lower inequality than they are showing. In the post-1986 period, we have a rise in inequality, but it's nowhere near as fast as what Piketty says are saying. And this all comes from accounting corrections to their data. This is not a normative claim. This is going through how they calculate their numerator and denominator and just fixing basic errors that came about from erroneous assumptions and data entry from them, cleaning up their series, scrutinizing it, putting on a stronger empirical footing, and that alone completely alters the picture. We also know that broader, expansive definitions of inequality have been revisited by some other authors. This came out in the Journal of Political Economy about a year ago, a paper by Gerald Otten and David Splinter, and they challenge another measure, a 1960 to the present measure from Piketty, Saez, and Zucman. It's more expansive because it uses some survey data that the IRS introduced in the 60s, so we can't go all the way back. But they found something really interesting. Similar to us, they found a much lower rise since the 1980s. And they also did something else interesting. They noted Piketty and his co-authors tend to represent income concentration as pre-tax, pre-transfer income. And yet they're making a causal claim about the effects of the tax system. So Otten and Splinter say, well, what happens if we actually take into account the effect of existing taxes that are already in the books? And if you adjust for taxes and transfer payments, it turns out that income concentration has remained essentially flat since the 1960s compared to this alleged rise that Piketty, Saez, and Zucman are showing. So already there, we have reasons to question their narrative based on the policy mechanism they prescribe, the effects of the current tax system. It starts to completely alter the patterns and dynamics of inequality. So I want to expand this line of study by also looking at other measures of inequality. And this includes in blue, you see my own corrections. This is the top 1% share, as well as different measures of the same thing or very closely similar things. Slightly different definitions of income on some of these, but they're all attempts to measure income concentration over time. And that includes Piketty-Saez. It includes Piketty-Saez's own extensions. It includes a measure introduced by the Congressional Budget Office in the 1970s, and it includes a subset of income that comes from Social Security wage data. And what you see in every single instance is that the Piketty-Saez series is this orange one at the top. Of all the different comparative measures of the same thing, especially from the 1970s to the present, they are always the most extreme. And I'm going to argue that's essentially not by accident. It's back to this question of putting the thumb on the scale. Same pattern occurs when we shift over to wealth share. Now, wealth is harder to measure because getting an accurate accounting of someone's net worth takes a lot of guesswork in it. This is why it's really complicated to do. I mean, if I were to ask you your net worth today, you'd have to estimate the value of your car, the value of your house if you own a house, estimate the value of all your stocks and assets, as well as what's in your bank account. That's not an easy calculation to do, and it's not one to do that you can do with extreme precision and accuracy. A lot of it is based on valuations. If I were to sell my house today, this is what I think the market would yield, and I might be off by several thousand or tens of thousands of dollars. But that's just a rough estimation. So there are really three ways to measure the wealth concentration. And this again is using US data. I'll show you UK data in a minute. Three ways are: one, you can look at estate tax data. And that's what the orange line here is. That's an earlier study that came out in the early 2000s, and it's since been extended to about 2013. They look at basically reported probates that go into the estate tax system when people die, and then the rate at which decedents occur over time, so you can estimate that, use it basically as a sample of the population and estimate the top concentration based on probate records and tax payments of the ultra wealthy. And that series, I think, is kind of interesting because it does show a decline in wealth concentration. But notice, at least until the early 2010s, you don't really have a rise. It's been kind of flat. Second approach that you have is the light blue line. This is survey data. This comes from the Federal Reserve in the United States. And what they do is they periodically conduct a massive survey of household characteristics. And it looks to try to estimate the net worth of ultra wealthy individuals. And then the Fed also uses, as they chain it to some other indicators, and produce a quarterly index of what they say the top 0.1% wealth concentration is in the United States. And notice it, the light blue line is slightly rising, but it's nowhere near what the Piketty say is in the dark blue figure. And then the third one is another measure using basically what they do is they take income reporting and they capitalize it. They project it in a conversion into wealth. And this is Piketty Saez, as well as some other authors have attempted to use the same technique. Piketty Saez, again, they have the highest rise, and one of their main competitors is actually it's rising as well, but at a lower pace. So again, you see the same pattern. Piketty, Saez, and Zucman are always the upper outlier in comparison. So what about other countries? This is where their line of research gets really influential because they discovered the supposed U curve in the United States and they project some of the same techniques onto multiple other countries. This is kind of a kitchen sink thing I downloaded off of their website. And again, you see almost everywhere in the world the same U curve pattern. World War II, everything declines. 1980s to the present, inequalities allegedly on the rebound. I know that's kind of messy, but I want to look at some subsets of this. Here are, what we call advanced economies, where we have reliable or reasonable data. Some of it goes back much further, but you can see where the United States stacks up against Britain, France, Germany, China, Sweden, and Canada in there. And again, the same U-curve pattern, all based on those original statistics of the United States they've attempted to replicate in other countries using tax data. And they claim it's basically the same interpretation that high taxes at the mid-century pushed down the capital stock, the private capital stock, and yielded a more equal distribution. Tax cuts since the 1980s to the present supposedly caused inequality to rebound across multiple countries. But I want to show you one more interesting pattern here. This is a whole different subset of countries that have more or less the same pattern with one notable exception here. What do you notice about all of these countries? They fell under communism, under the Soviet bloc, at some point in the 20th century. And the really interesting thing here is the green line. What is that? That's the Soviet Union and Russia. Estimation of top 1% national income share concentrations. And Russia, unlike anywhere else, drops from very high inequality to very low inequality at an exact moment called 1917, the Bolshevik Revolution, and then supposedly rebounds at another exact moment, 1991, when the Soviet Union falls. So you start looking at this U curve, and it may cause you to kind of scratch your head. Well, what about other communist countries? We don't have the best data, but there are some existent stats from the Czech Republic and Hungary in particular. And you notice they have the same pattern, but instead it's 1946 that they decline, all the way up till 1991, then they allegedly rebound. Include China in there as a communist state, also Poland. Unfortunately, we don't have data going all the way back, but we do see the rebound portion of the story here. And you start to ask, wait a minute, if these stats are showing high periods of equality at the peak of the Soviet era and high periods of inequality both before and after that, are they actually measuring conditions on the ground? Or are they just measuring relics of official reported statistics? Think about the Soviet Union. Is it a society of high levels of equality? Very much not so. If you're a member of the party elite, you have an extremely luxurious life. You have access to all manner of estates and vacation homes and modes of travel and access to products that the average member of the Soviet society does not have access to. So you have extreme inequality between the top and the bottom, but measured inequality, everyone's at the bottom is almost equally poor. So it looks like, as a relic on paper, that they have high levels of equality. Same thing in other Soviet influenced societies at mid 20th century. So I call attention to this, saying that maybe the measured statistics are not actually capturing the full story on the ground. I also want to jump over to the UK. And this comes from a study that I published in Social Science Quarterly a few years ago, and it looks at the Piketty data versus other estimates of wealth concentration in the US. And I show overlaid here top 10% and top 1%. So Piketty, his published data are the dashed lines. You see it, that yellow dashed line at the top and then the black dashed line at the bottom. Overlaid with Revenue Commission data that's conducted by the survey out of the UK government and some other measures. And you see a very different story. Um, what is that? Well, the drop is occurring at roughly the same period, but whereas Piketty shows a rebound starting in the Thatcher era in the late 70s to the present in wealth concentration, official revenue statistics actually level out and remain at their much lower level from about 1980 to the present. So I could interpret those statistics as saying, well, maybe Thatcherism worked and kept inequality level. Whereas Piketty would say it's rebounding. So there's actually a gap between what he claims and what the data sources reveal. Now, the other interesting thing here about the UK is Piketty cited his data source to the same underlying statistics from the Revenue Commission data, which you see in the raw representations versus his numbers. And there's a gap of several percentage points, 10 to 15 percentage points gap for the top 10%, and then a similarly pronounced gap for the top 1%. So how is he getting a rebound out of raw data that does not show that rebound at all? And this replication study I did showed that there was basically no way out of his data replication files that he provided to get the numbers that he claimed. In other words, he was putting his thumb on the scale again to tell the story of a rebound. Now I want to turn my attention to some of the implications and claims that are often made. And we'll wrap up on this. And this is the question, do the rich really pay lower taxes? Because it unintentionally revealed something interesting about the Piketty data series for the United States. Because in 2019, they went to the New York Times and they claimed this Warren Buffett statistic had verification in official tax records that showed that the rich are paying lower effective rates today than they did in, say, the 1960s. And they claim that this is the mechanism that drove the rise in inequality. So it was a big splashy news line. It was never peer reviewed. And they presented to the New York Times this particular statistic, the study. They claimed it was the 400 wealthiest families in the United States, dropped from an effective tax rate of 60% in 1960 to just under what the bottom 50% pay today. So about 22, 23% in the most recent data. And again, you see the biggest drop again is that 1986 period. Allegedly, causing a decline in the tax burden on the ultra wealthy. And they say that this is a mechanism that aligns with inequality. And I asked the question, well, why are they rolling this statistic out right then and there? And it dawned on me that they had published a previous paper that actually measured effective tax rates. Because, for their causal mechanism to be true, you can't simply use statutory tax rates. It's the actual effective tax rate by income bracket. And I went and dug up the replication files that they published with that earlier paper just about a year before this came out and overlaid it with the measure that you see in what they gave the New York Times. And there they are side by side. The blue line was their previously published statistic. The orange line was their new data set that you see also reflected in the New York Times. And this is the most closely comparable category, top 0.001%. It's about the richest 1,000 to 1,200 families. So very, very close to the 400 richest families measure they gave to the New York Times. But we're talking multimillionaires and billionaires here. And what do you see? What changed between their two published statistics? Well, in the earlier version, the blue line, the effective tax rate on the ultra wealthy in 1962 was about 44%. Fast forward to 2014, the depicted effective tax rate on the ultra wealthy in 2014 is about 41%. A very, very small drop in the actual effective tax rate. Now, there are fluctuations. These are tied to deductions of capital losses during the Great Recession, for example, that causes a brief decline. It's not any change in tax policy, it's just economic fluctuations. But more or less, the rich are only paying slightly lower effective tax rates today than they did in the 1960s. This is a wrench in the Piketty policy narrative because if effective tax rates are the mechanism that are keeping inequality in check when they're high or allowing inequality to explode when they're low, if you see no change or very little change in effective tax rates over time, then the causality collapses. So what did they do? They revised their numbers by changing assumptions around to where now they claim that the ultra rich paid 55% effective tax rates in 1962 and only pay about 25% today. So they completely altered their numbers. Did they discover something new to change their numbers? No, they actually tweaked their assumptions in the underlying model and adopted a very heterodox assessment of how corporate tax burdens are distributed. And in so doing, it just completely inverted and changed their charts. This was interesting because Piketty, Saez, and Zucman embraced this narrative without stopping to think, well, wait a minute, our own previously published work contradicts it. What can we do to reconcile the two? And Zucman was actually the main culprit here. He temporarily removed his old replication file from the previously published paper off of his website and replaced it with a new one that had the dotted lines instead of the solid lines there. And I just had fortunately downloaded the previous version, decided to compare them side by side and said, wait a minute, something is wrong. And on October 10th, 2019, when I discovered this, I tweeted it out to the world, went to bed, woke up the next morning, and this thing has blown up the internet. Larry Summers calls out Saez and Zucman a couple days later in a public debate and says, you guys are fudging your numbers, basically. Where does that lead us to? Well, a few conclusions, some interpretations I want to put into this, but some basic concluding point. One is that on most measures of income and wealth concentration, the Piketty et al. Literature always ends up as the upper boundary outlier. And I would assert that this is not random chance that it does so. It's in fact a result of methodological decisions in their data construction that tend to place the thumb on the empirical scale to fit the political story. And if you actually compare it against other measures and other techniques for measuring the same thing, as well as corrections to their own series, you always see a much more tepid and gradual rise of inequality in recent years. And in fact, one thing that we'll also note in some of our own data, we find that rise may have peaked around 2010 instead of continuing to go up in the United States, as Piketty and Saez assert. The second major implication is if you actually look at other measures of inequality and you adjust them to account for existing taxes and transfers, inequality is not a crisis at all, as we saw in the Otten and Splinter paper. In fact, we're hovering around the same level post-policy intervention that we were in the 1960s. I have some of my own ongoing work is to extend this back to the 1940s, and the same story actually plays out. Basically, since the advent of the modern welfare state, uh, the government programs, whether we like them or not, are in fact doing a an effective job at leveling the playing field in economic concentration. And other measures have other corrections have been done to different measures of the same thing. So, for example, there's a survey run by the U.S. Census, and if you correct it for taxes and transfer payments, you find out that between the mid 20th century and today, there's almost no rise. So what this comes down to is that the foundational stylized fact of Piketty et al. That's picked up in all of these other literatures and just repeated ad nauseum as if it's absolutely gospel is simply not tenable. It's not reliable, certainly in the US. And then insofar as we've tried to replicate it in other countries, such as what I showed you in the UK wealth data, you also find the same problem. So the stated justification for all of these policy interventions turns out to be essentially faulty. When you do basic standard empirical accounting corrections to the data in basic standard internal robustness tests of what Piketty and all are claiming against other measures of the same thing. So that leads me to a conclusion that their claimed crisis of inequality, their claimed basis for an international tax standardization regime that supposedly holds down the capital stock, is actually a relic and product of some extremely unreliable statistics. So before we start asserting that there's an inequality crisis, my challenge to all of you and to policymakers in general is to actually show the numbers, actually scrutinize the numbers, and see if they are demonstrating what Piketty says and this broader body of literature claims. And with that, I'll go ahead and open it up to questions.
All right, so thank you, Phil, for the presentation. So, for the audience members, feel free to start dropping your questions in the Q&A. I will begin posing them to the speaker. Perhaps, Phil, let me just throw some questions that I have on my own first.
Yeah, yeah.
I have about three questions, if you don't mind me just asking one after another. The first really is about your evaluation of Piketty Saez. So there seems to be really be a discrepancy between what you are saying and what they have presented.
Mhm.
So I can't help but wonder, what exactly is the root issue? Is it a case of genuine ignorance or genuine error,
Mhm.
where you are, using certain assumptions and therefore picking some data that fit your narrative, or is it a case of just something more sinister where there is
Yeah,
even like
right, right.
dishonesty and fraud, right? So what exactly do you think is the root issue here,
Yeah,
right? The next question I have is, even if I agree with you that their data is problematic,
yeah,
how significant is that in the context of the broader discussion of inequality? Like what's the big deal? Even if their data is suspect, don't we have corroborating evidence elsewhere that seem to tell, a generally similar picture, right? So for instance, okay, so Gini coefficient is problematic,
sure,
but
sure.
let's say we talk about like the shares of income, right? There's lots of data telling us that, the share of the 10% or the top 20% has grown, right, over the past decades. And I mean, if you look at it, I think that's pretty
Yeah,
pretty clear.
yeah,
And then, you have other studies that say, like the ability of an average person of out earning your parents, right, over the generations seems to be declining. So people use that as a measure of like social mobility, income,
right, right.
right? So you have like different approaches that seem to say that. So you know what I mean? Like, so even if this is problematic, so what? Right? And then my last question, if you don't mind, is more about the normative problem or justification of inequality in the first place, right? So economic liberals typically say, it's not about inequality that matters, but the absolute increase in standard of living,
Yeah,
right?
yeah,
But people who are concerned about inequality, they have a response. They say, even if the absolute standard of living is increasing, inequality is still a problem independently. Because when you have, disparities, assuming that really does exist, then that means there's social polarization. People lose trust in the economic
yeah.
system. They don't feel like they're getting something out of it. So there are social political problems of inequality independent of the absolute increase or the absolute level of the standard of living.
Right, right. So yeah, I'll tackle each of those three questions. The first one, the nature of the errors in Piketty says, and I'd split this into two categories. The first are what I would refer to as sloppy errors, casual errors, errors made from just a very superficial analysis of the data. Sometimes it's misreading old PDF files from the early 20th century of tax records. Sometimes it's entering in the wrong number. Uh, these are sloppy mistakes. And the original Piketty Saez series is filled with these types of mistakes, is what we found. Basically, my foray into this question started by trying to replicate their paper, and I start finding that I'm getting very different results and that there are very questionable assumptions that they make. I don't think there's malice in that insofar as they set out to like prove something using data fraud. But I do think that they were sloppy because the results they were getting were confirming a narrative they expected to see. So it's like if you run a model and it generates results that align with your political story, you don't look any deeper in that model. You just say, oh, well, this is exactly what I expected to find, and therefore they run it. And the other thing I note about their work, especially this early work, is every error tends to tilt in one direction. It's not a random error. If we had chalked this up to data sloppiness, you would expect, just based on the normal distribution, that about half of the data errors increase inequality, the other half decrease inequality, and they basically balance out if it's just pure random chance sloppiness. Uh, what we actually find in Piketty and Saez is that the sloppiness all tilts in one direction, not the other. Now, again, I don't think this is malicious design. I think it is confirmation bias playing out. They started to get the results they wanted to see, and therefore they didn't scrutinize their source data with sufficient detail to actually detect some very serious problems in it. Uh, Now, where does the malice enter in? I actually do argue that some of that has come into later subsequent research. And this is in particular the Gabriel Zucman editions. So the effective tax rate stats that they released to the New York Times. And I've publicly accused him of data fraud. I have no reservation about doing that again because he quite literally removed a replication file from a published paper off of his website and replaced it with something else that had different numbers without explaining what he did. That's an ethical shortcoming in the social sciences, and certainly it's something that's published at the Quarterly Journal of Economics, a top journal. He did get caught, and then he kind of backtracked and tried to rationalize what he was doing in there. But if you look at his rationalization, it's really what we call data massaging. He's going through. He realized he had an internal contradiction in his numbers from the tax stats he was showing and the tax stats he needed to show for his argument to work. So he changed those stats in really contrived ways by reassigning corporate tax incidents, for example, or by stripping out tax credits. So earned income tax credit is a benefit that helps lower income individuals in the United States, and he strips that out and no longer counts it as part of his effective tax rate calculation. All this has the effect of bending the numbers in the direction that he needed to show. So it's like making data choices to yield the result that he
Mhm.
wanted rather than to follow some neutral scientific basis for coming up with a measure here. So that's where I fall on the line. It's a mixture of sloppiness early on, followed by malice later on.
Hmm.
As relates to the other questions, yes, there are certain other indicators that show that there is a rise in inequality in recent years. That's both income and wealth concentration. So, for example, I look at the Federal Reserve's measure of wealth concentration. It also is going up over the same period. No doubt about that. But it's not going up at like this unprecedented uh, crisis rate where it's skyrocketing is what you see in the Piketty Saez chart. Instead, you see a very tepid, gradual increase that is well within historical norms. Uh, Income and wealth concentrations have never been static across world history. They always do go up and down, and you should expect some fluctuations in that. You dig a little deeper into the Federal Reserve's data, though, you also find something else interesting going on. The net worth of people in the bottom 20% or the bottom 50%, lower incomes to lower middle incomes, if you use these segments of their net worth calculations, they have pronounced credits that are going on toward their net worth. So one of the subset measures in there is consumer durable goods. These are things like large appliances, cars, vehicles, things that are worth something, but and they fit into your net worth calculation, but they're not the same thing as like your bank account. And it turns out that's grown at a very large rate among lower income people. Their net worth from consumer durables that they possess has increased very sharply over the past 30 years or so. But at the same time, there's a net debit that's increased very sharply among the lower wealth level individuals, and that is consumer credit. They are essentially purchasing things on credit, and that is also working against their net worth. And I
Hmm.
would argue, if you look at this, the fact that consumer credit has expanded to lower incomes means that a lot of people have better lives.
Hmm.
They're able to purchase a cell phone. They're able to acquire a lot of goods that were previously luxury items, but they're doing so on credit spending. So it's a debit against their net worth in that sense. So you have a lot of countervailing nuances to the story that play off of each other. And then back to that third question, the question about perceptions. Yes, if you look at the survey data, there's a perception that inequality is an astronomical crisis of our current era. But I'd ask, how does that perception stack up against reality? Well, the first reality here is that pre-tax income, yes, does seem to be rising slightly, but post-tax income concentration levels are not. In fact, if you make that simple adjustment with the tax system that we have, the actual money that people are taking home in their paychecks, the distribution of it has not changed since the 1960s in any meaningful way. So realized income versus on paper pre-tax income are two very different categories. And what people are actually incurring in their daily lives, what they have to spend, is determined by realized income, not pre-tax income. So this tells me that all the survey data and the perceptions of rising inequality are actually a relic of the political arguments that have been made asserting that inequality's gone up, not actual reflections on something that I'm taking home in my paycheck. So you actually have a divergence between the statistical reality and the public perception, and quite a bit of this has been inflamed by heated and exaggerated political rhetoric built upon the faulty stats of Piketty, Saez, and Zucman.
Right. So going back to the second question before I bring in some of the
Mhm.
audience members, I'm not an expert on measurement of inequality, but my impression that one of the more reliable approaches here that will actually be constructive would be to track the income earnings of specific individuals and households
Yes.
in a certain
Yes.
year, and then tracking those same households and the same individuals over a
Yeah.
10-20 year period to see whether or not they still remain the bottom quintile, for example,
Exactly.
or they have
So you actually
actually
get
moved up.
mobility.
Because that's
Yes.
actually a measure of like income mobility, not just a static snapshot of difference in two groups, right? So
Yeah.
so based on that, is there much data and analysis in through that approach, and what does that say,
Yeah.
actually?
Yeah. So yes, I mean that would be a far superior approach insofar as we could do it. Unfortunately, we don't have data more than a couple decades back on that. So we can't really go back to the 1960s, but we
Mm,
can go back to the 1980s, and there have been certain attempts to do that, both by tracking known wealth and assets of extremely wealthy families, and then also there have been some certain survey instruments that actually track the same household year over year over time. And they find that there is actually quite a bit of mobility, both at the bottom, families that used to be in the bottom 20%, they jump into the one of the middle quintiles, so the 20 to 40% quintile or the 40 to 60% quintile over the course of maybe a decade in time. And a lot of this follows like a lifespan. It follows entry into the workplace at a very low income, and then as you advance through the mature ages of your career, you get into your age 40 and 50, when you're in a more senior level on the job, you actually do jump up an income quintile. The second set of measures looks at extremely wealthy families, and this is like the Forbes 400 list.
mhm,
And you can go back to the 1980s and see who was on the list at the time versus who's on the list today. And some of those people are still alive. So you can actually see how that changes. And it turns out that the ultra top elite of the list today did not even exist 15, 20 years ago on the
mm,
Forbes 400 list. A lot of it's just driven by tech billionaires and people that have had major breakthrough innovations. They got their wealth through that innovation, not through some inheritance from being a descendant of the Walmart family or the Rockefellers or one of these old wealth style families, even though some of those are still in the equation.
mm.
But you actually see quite a bit of fluctuation at the very, very top of the list. It's a different class of billionaires we have today than even 10 years ago.
Great. So, okay. So let me just bring in some of the audience questions. So for the audience members, please now throw your questions if you have any in the Q&A section. So the first one is from an anonymous attendee. He says, "Hello, thank you for the presentation. In your data, comparing with Piketty Saez for the 5%, 1% and more richer groups, the difference is very small. Isn't this a corroboration of the PS data and main conclusion?" So I
Yeah.
think this goes back to my second question,
Yeah.
which is that even in your calculation, is there okay, sure, even if his is like a more
Yeah.
exaggerated, like is the difference really that big for us to be really worried?
Yeah. No, and that's an entirely fair question. I mean, you're talking about changes in income percentiles, where, so for example, in some of our data in the top 5% or top 10%, it's only a couple of percentage points differences that we get at the two tails of the chart. So that does look small by comparison, but in terms of historical fluctuations, it's actually quite a big deal, because they're asserting that the top 1% jump by 4 or 5 percentage points, and when it's
Mhm.
actually like 1 or 2 percentage points
Mm,
over the same period, you've completely altered the equation there. So I guess the question would be to ask, look at historic rates of change, not absolute levels. And if you look at the historic rates of change, our data shows a much more tepid rise or decline in the early part than what their data show. I guess in other words, they're always at the extreme upper end
mm.
of showing inequality and the extreme nature of the swings. And I guess another dimension of that, what it shows is if you have a more tepid rise or a more tepid decline in any given period, that weakens the causal claim that this is actually the result of tax rate changes.
Right.
In other words, for tax rate changes to be determinative, you actually have to have a very pronounced swing in one direction or the other, or else it may be that tax rates are not what's actually determining income concentration to increase or decrease at the top. If it's something else besides the tax system, then their whole suite of policy prescriptions goes out the window. It's no longer the case that you can actually control or manipulate income concentration by slapping a higher or a lower tax on it.
Right. Okay. So we have one more question. I think that may be the last one from Heldo. I think it's a clarification question on the point about the Soviet states.
Mhm.
Czech Republic and other countries only entered the USSR and a communist administration after World War II. So
Right.
the big
Right.
decrease only after 1945, combining as well as with the destruction of capital makes sense.
Yeah.
Sorry, I think I didn't understand your critique here. So I think it's just a clarification question.
Yeah, yeah.
Yeah.
Yeah, so you're certainly capturing the effect of the Iron Curtain falling across Eastern Europe. Basically, what I'm pointing out, though, is that in that era, Piketty says in their data, they adopt assumptions about the communist world that assert that greater equality has been attained.
Mm,
And because of those assumptions, what looks as an official statistical measure on paper appears to show extreme leveling and equalization of those societies. And yet, if you actually go into historical accounts of how life was on the ground in the Czech Republic and Poland and the Soviet Union, you find evidence of extreme experienced inequality.
yeah.
So, inequality on paper looks like things have gotten a lot better after World War II in all of these countries. Inequality in practice, it's the party elite are living lives of luxury, everyone else is mired in poverty.
Right. So, Phil, before we end, I just wanted to make an observation which just came to me. So, you are actually saying that the inequality that is detected in Piketty size is not as serious as they made it out to be, partly or probably predominantly because of the effectiveness of the tax system and the
Yes, yeah.
redistribution that has actually been working. And that's actually very interesting because I suppose, as an economic liberal, right, you are actually saying that that actually has worked, right? So
It's one of the
that,
weird
that,
implications,
that
you know?
actually has
Yeah.
worked. So the irony is that their data, by showing inequality to be higher than what it is, actually undermines their own case about the effectiveness of the tax
Yeah.
system, which they claim is effective. Because if it was so effective, then why is it that
So there's a
that level?
circularity in their argument. Their argument presupposes pre-tax income distributions to make a claim about the effect of post-tax income. This is like citing your own prescription as the cause of the data that you have, without accounting for the fact that that prescription is already in place. And this is one of the more interesting and surprising effects. So I find this, there's a separate book that studies the same question using census data in the US by Phil Graham and Robert Ekelund that came out, and they do the similar adjustment for tax and transfer payments. And they find effectively the same thing that the tax system that was put in place in the 1930s, 40s, 50s, and it has effectively remained in place to some degree to the present day. I mean, there's slight changes in effective tax rates, but the modern redistributive effects of the income tax are evident in the data, and it's effectively already accomplished what Piketty and Saez say their goal is. In other
Wow.
words, it makes their argument moot. And I can say this as a person that favors low taxes for my own normative reasons. Nonetheless, the tax system that we have moots their argument for higher taxes.
So that is the big irony here because even though you are criticizing the inequality data, your
Yeah,
critique actually implies, and throws the welfare system in a positive light.
in a weird
And that,
way. I mean, I think
yeah,
there are problems with that welfare system. There are problems with redistribution for other reasons.
yeah,
But if we're looking strictly on the measurement of the income distribution effects of the tax system, it has achieved already what Piketty and say we need more taxes to achieve.
right. Right. All right. Thank you very much, Phil, for that great
Absolutely.
presentation and the questions. So I suppose there are no more questions. So thank you very much, ladies and gentlemen, for attending. We have future events and future webinars. If you have registered for this, you will be in a mailing list. You may unsubscribe if you want, but you will receive announcements for future events. Thank you very much. This webinar will be posted on YouTube with the link to Phil's book chapter. Thank you very much and see you all again. Thank you, Phil.
Thank you again.